Hey, I'm going to talk to you today about 15-year mortgage versus a 30-year mortgage. And if everything you thought to be true turned out to not be true, how soon would you want to know? After all, Dave Ramsey says, Susie Orman says, the talking heads say, and I know some of you are sitting there going, this guy works for a mortgage company and all that other kind of stuff. Well, just follow the number, folks. Just follow along and follow the mathematics. Because if you follow the mathematics, you might just get this. So 15-year mortgage versus a 30-year mortgage, an investing strategy. So mortgage comparison to 15 over a 30-year mortgage. Well, 15-year mortgage, we have higher payments. We have lower total interest, but we're going to have higher payments. We're going to have a higher obligation on a monthly basis on how much we're going to have to pay out over that 15 years. In a 30-year mortgage, we have lower payments, but we have higher total interest over the period of the 30-year mortgage. So yes, I will grant you that we will pay less interest on a 15-year mortgage. But that is not necessarily a good thing. You see, interest rates are lower for 15-year loans, and they're more flexible cash flow with 30-year loans. So if I go out and get a 15-year loan today, I'm going to get a lower interest rate, generally by a half a percent to a point less than what it's going to cost me to get a 30-year loan. But if I get a 30-year loan, I'm going to have more flexibility with my cash. In other words, I'm not going to have such a huge liability every single month that I have to come up with. Now, let's take out a loan amount here of $300,000. And look, I don't care what interest rates are today. Interest rates are relative. Interest rates have been as high as 22% on mortgages, and they've been low as 1.75, depending upon where you are. And many of you watching this video out here probably have interest rates on your mortgages between 2s and 4s, possibly 5s. And they're going to fluctuate. They're going to continue to fluctuate going forward. So we're just going to use some simple numbers here. We're going to use a 15-year mortgage at 5%. The payment on that would be $2,372, and the interest paid over that 15 years would be $127,029. Now that payment does not include mortgage interest, it does not include HOA fees, it does not include taxes, insurance. It's just the principal and interest payment. On a 30-year loan at 6%, the payment will be $1,799 a month. Now, we would pay in interest $347,515. So can we agree, please, rather than getting in this huge heated argument about we got to pay all this extra interest, we'll agree right now that we're going to pay less interest on a 15-year mortgage than we are on a 30-year mortgage. But you see, folks, there's a difference in between those, which is $574 a month. Now, if we put on our big boy and big girl pants and we actually are responsible with that money, and we take that money and we side fund that money, you're going to be amazed at the difference over time of the opportunity that we're going to get out of that money by reinvesting it. So we take that extra $574 a month and we invest it. Now, we're going to assume a rate of 8% annual rate of return. Folks, we can argue about, well, I can make 12 and I can make 6, and where are you going to get better than 6, and blah, blah, blah. The bottom line is, if I was to take the S&P 500 and I was to average it over the lifetime of the S&P 500, I would find that I'm definitely going to be in the 8 to 12% average rate of return. So we're going to use 8% average rate of return right now. If I grew that money, if I was putting that money away at $574 a month over that 30 years, at the end of that 30 years, I'd have $855,063. Now, do you happen to remember the amount of interest that I paid on that on the 30-year mortgage? Well, think about that as to what that would be going forward. So we take a look over here. We got a 15-year mortgage. You can see that we paid interest down there. It was less than $150,000. And on the 30-year mortgage, we paid interest of about $350,000. But over here on the investment side, we had over $800,000. Folks, that means that if you went out and you took that 15-year mortgage, okay, over there. Well, that's great. You would save on that. But the bottom line is that the amount of interest that you would pay, it'd be very small. But look at how much money I grew in interest on the right side. It's about a $450,000 error. So 15-year, less interest, faster payoff, but higher monthly cost. Which, if something happens along the way, we lose our job or something like that, we have a huge liability that we have to pay every single month. 30-year, more interest, lower cost, more invested into potential growth going forward. If the investment returns, mortgage rate, and investment is smarter. So in other words, if the investment return is greater than the mortgage rate, well, then it's a smarter way to do it. But would it surprise you to know that if I actually had an exact same rate, if I made what I was borrowing at, I would still come out ahead. As a matter of fact, if I made less than what I was borrowing at, so for example, if I showed 8% rate of return with a 5% or a 6% cost over here on the mortgage, what if it was 6 and 6? I'd still come out ahead. What if it was 5 and 6? I was making 5 on my money and 6, I'd still come out ahead because I'm paying on a declining balance, the mortgage, and I'm making on an increasing balance, the investment. Choice is based on risk tolerance and financial goals. Now, folks, if you're going to take that extra $500, $600 a month and you're just going to go consume it, then you probably should put it in your house. But houses were made to house people, not money. Because you see, the rate of return on equity in your house is 0. Yes, that's correct. The rate of return on equity in your house is 0. Let's just say, for the sake of argument, that you owned a house right now, and the value of that house was $500,000. Would that house go up or down in value any faster if I paid it off? And the answer to that is no. It's going to go up or down in value regardless of how much equity is in the house. So it is the house that is appreciating, not the equity. So the rate of return on equity is 0. So we're losing money on two fronts. The value of that dollar is becoming worth less and less every day, and opportunity cost. If I invested that money somewhere else, I would have a better rate of return. So let's look at detailed mortgage breakdown here. I have a loan of $300,000, 15-year mortgage, 5% is $2,372, $127,000 in interest. 30-year is 6, $1,799, $347,515 in interest. The cost of extra interest over time is $220,486. Now that's a lot of money. I'll grant you that is a lot of money. But by taking that different money and investing it off to the side, I end up in the first 10 years with $106,000, in the first 20 years, $340,000, and in the first 30 years, $855,000. As a matter of fact, if I took that money and I invested it over off to the side at $574 a month, at 8% rate of return, I'd actually be able to pay off my 15-year mortgage, or instead of paying, I could take my 30-year mortgage and pay it off in like 13 and a half years, as opposed to 15 by paying all that. Think about that for a second. So take a look here. You can see on this chart here that you've got your 15-year mortgage, house is paid off. You got your 30-year mortgage, house doesn't get paid off to 30 years, but you've got that investment that's running out over that period of time. See, if you think about this just from the standpoint of right here of what's happening today, none of this makes any sense. But when you look at it over a 30-year period of time, it's incredible the difference in the numbers. And remember, the choice is always yours. So historically, the stock market average is about 7 to 10% returns, or even better. But see, when we're investing that money, we also have liquidity. Once we put that money inside of our house, it's no longer safe, it's no longer liquid, and it no longer has a rate of return. Would you call that a good investment? Would you put your money in an investment that's not safe, it's not liquid, and it doesn't have a rate of return? I wouldn't. So why would I pack all this money inside of my house? Now, diversification investing spreads risk across multiple asset groups. And remember, return on equity is zero. So if I've got all my money tied up in my house, I don't really have diversity. It's tied up in my house. There really only are three ways to grow your money. You can grow your money in tax as you go, which is your cash, certificates of disappointment, bonds, 1099s, etc. And you can grow your money in tax deferred. That's your qualified accounts, 401ks, IRAs, 403bs, etc. And tax deferred annuities. And then you can grow your money tax free. You can do that in four areas actually: 529 plans, Roth IRAs, muni bonds, and maximum funded index universal life or whole life. Now, the choice is always yours, and whether you want to believe what I'm showing you here or not, the math speaks for itself. And folks, I don't work for a mortgage company. But what I want to hear from you is, what do you think about this? Do you think it's better to have a 15-year mortgage, a 30-year mortgage, pay cash for your house today, which most people couldn't possibly do? Or should you take out a 30-year mortgage and then bank the difference? Are you responsible enough that you would bank the difference? And when it comes time to bank that difference, are you going to bank it in a tax-as-you-go environment, a tax-deferred environment, or a tax-free environment? We have lots of other videos on this for you to learn about this. So be sure to go subscribe to our channel and go watch some of those other videos. And please comment below, share this with friends and family, and remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling, and I look forward to seeing you again very soon.